All right, welcome back to Street Smart. There's a reason why we call the show Street Smart. It's because we try to bring the smartest people in the world onto the show so that they can share their perspective with you. And our next guest fits that bill. He is Tom DeMark. He is one of the most widely followed technical and market timing analysts in the country. He joins us from Phoenix. Tom, it's great to have you here. You made a hero call way back in May. You said that the S&P would stop at 1076. Okay, you were off by 2 points. It went to 1074 yesterday, a hero call. I know a lot of big names on Wall Street made a lot of money from that call. How'd you get there? How'd you come up with the number?
Well, I'll tell you, just to give you some perspective, if you were to go back to March of 2000, and something as simple as this, just take 50% of that high day's close on the March peak, you would arrive at 776, which happened to be as well the low in October of 2002. And if you were to double that low, you'd arrive at the October 2007 high. And using that same type of analysis, we used a derivative of that approach, and we took the May 2nd high when we had a confluence of a number of models indicating the market had topped that day. We took 78.5%, really 78.56%, and we arrived at the low yesterday, which was the 1076 projection. We rounded it off. The actual low was 1074.77. You know, looking out into further, go ahead, I'm sorry.
Well, I wanted to say, and we were on the phone with Leon Cooperman earlier. He called you a hero. He said that was the hero trade of the decade. You absolutely nailed it. And what you just said, I almost hate to interrupt you, but I just wanted to let people know how many guys follow you. The key is now, what do you think? You got that one right, so now everyone wants to know what your next call is.
Well, we're at a very pivotal, crucial point right now. The market short-term reacted too aggressively yesterday, and it almost indicates that the market could be responding more to short covering than really investing. Tomorrow would be is a very important day to us. If the market, for some reason or another, tomorrow or Friday morning, is able to struggle and reach 1188 on the S&P average, that would be close to a 40% recovery off the low yesterday. And typically, when markets have 3-up closes and do move that quickly, that's a sign of a termination of a short-term move. And instead of looking forward and expecting the market to move higher, the market could have a very sharp decline. So we're looking closely at tomorrow and Friday morning.
So if I'm hearing you correctly, 1076 was a low. It's not necessarily the low.
No, it's the reason for that being at the May 2nd high, when the market doubled the move from the March 2009 low, there was a confluence of daily, monthly, and weekly indications from our market model. They all produced what is called the sequential and combo 13s. And that told us to aggressively go short. What we've experienced yesterday with the S&P average, as well as other markets, was a 13 that coincided with a daily low. So we're really going against the trend right now. But what was so supportive of this move was the fact that the commodities markets, wheat, soybean, and crude oil, they all produced 13s yesterday at the same time the stock market did. So I think that's what provided the impetus and the sharp steep move to the upside. Like I said, we just got to watch it closely. People are not smart off of market bottoms. Our whole thesis is that markets bottom not because of smart buying. It's rather an absence of selling. And what we're seeing right now is buying, and that's indicative of short covering. And what typically happens if you do get 3-up closes off a low, you'll see a vacuum in the market, and that vacuum will accent the decline even more than the upside. So we just got to monitor closely tomorrow's trading. If it's very strong, and if the news on Friday is either positive or negative, we could have a sharp decline and undercut yesterday's low. It's yet to be determined, though.
We will be in touch with you to try to bring all that information to the viewers. I want to share a chart because you pointed this out, sort of deja vu all over again. We're starting to look like what we saw in 07, 08. Take a look, all right? We'll start with the market. And again, you showed us this earlier. It's a chart of the S&P from September of 2007 to May of 2008. Shows the number of trading days from the top to the bottom. All right, now if you bring in the overlay of the S&P since May of this year, the numbers, they are very eerily similar. In other words, they're kind of lining up. So it's almost as though we have a roadmap for what might happen over the next couple of months. Talk us through that for just a minute.
Sure. On a longer-term basis, in the year 2007 through 2008, we used the 1973 to 1974 stock market decline for our GPS, and it worked very well. What we've done over the last 2 months was align the market as of May 2nd with the peak in October of 2007. And you can see 108, 109 trading days is what had elapsed into the March low prior to a 14% rally in 2008. And that's what we could be experiencing right now. But like I said, we'll be more aware of what's occurring given tomorrow's price activity. But like you said as well, the similarity is very eerie.
Yeah, very similar. So just to summarize, we've put in a low. We might go down and create another low, but ultimately you're looking for a 14% rally if history repeats itself. A great roadmap for us. I want to move on to just a couple of the commodity calls. You've made a big call on both gold and oil. Talk to me about gold first.
Well, gold also gave us a 13 sequential combo at the high, in fact, in the first day of May. We projected downside to a level 1603.90, and that happened to be what we call a TDST level. And the market had been trading around that level for 2 weeks and was unable to break it with the exception of one day in which the market broke. But the following day, we opened higher and above that level. There's a good chance that gold is going to resume its uptrend and exceed the 1923 high that it recorded in Globex trading and move up to the psychological level of 2000. Typically, markets that are in parabolic moves top out with round numbers. In this particular case, it makes sense on a spike with some news inspired that the gold will hit 2000 intraday.
Okay, great comment.
Silver, obviously.
Great comment. I'm going to have to interrupt you because I wish we could keep going all day, but we're only going to have about another minute or so, Tom. So just quickly, give me your call on crude oil, because if I read you correctly, it's slightly different. You're bearish.
Yeah, crude, we turned bearish in the market as well during that same period of time, and we've been looking for $69.5 to $72 on crude. We didn't quite get there yesterday. We did receive one indication of a bottom yesterday, and that was with an indicator we call combo. We recorded a 13. Sequential is lagging by 1 day, so we see crude being undercut. The chance of this being the low, I think, is a pretty low probability. We should make one lower low, and we'd look for a range between, say, 70 and 72.5 cents, or 72 and a half as the bottom, and then a serious move to the upside.
And Tom DeMark, I'll tell you, I got an email from one trader told me there was huge put buying today, abnormally so, on crude oil. We appreciate your joining us, Tom DeMark from Phoenix, widely followed market technician and market timer. Tom, thanks. We'll check in with you over the next few days and weeks to see if you're going to update your call.